Okay, good afternoon, students of taxation. In this video, we're going to discuss the continuation of our discussion on deduction from gross income. So, a quick review or quick recap on our on part one of deductions from gross income. Last video, we have discussed deductions, the definition, the types of deduction, that is OSD and itemized deduction. So in this video, we're going to focus our discussion on the different types of itemized deduction. Okay, so optional standard deduction, we have already discussed that one on previous video. Kindly check the recorded video on the first part of deduction from gross income. So we have already explained how to compute your OSD for corporations and individuals. Then, for service concern, we have already discussed how to compute for the OSD. Then, we have identified what are direct and indirect costs. Then, important rules in availing your OSD. So, itemized deduction, we have already explained the first part of itemized deduction in general. Okay, so we have already identified. So each example that the National Internal Revenue Code enumerated in this slide will be individually discussed in detail in this video. So then the itemized deduction from gross income. So these are the items that is not deducted from the gross income of our taxpayer. So we have reviewed, let's review the requisites for deductibility. So we will use these general requisites for all itemized deduction that we're going to discuss today. So it must be ordinary and necessary. It must be paid or incurred during the taxable year. It must be supported by vouchers and or receipts, or in our term, it should be substantiated. Then, if a withholding tax is required, such tax must be withheld and paid to the Bureau of Internal Revenue. Okay, so that is very important. So this is the first topic that we're going to discuss in part two of deduction from gross income. So the first item of examples of itemized deduction is what we call contributions. Okay, so donations and contributions are amount given to government and non-government entities, whether in cash or in kind, for the purpose of charity and other related purposes. Okay, so contributions and donations can be deducted from gross income if they are expenses in the conduct of trade, business, or in the practice of profession. So even though it is a charitable contribution, it should be aligned or in the capacity of the taxpayers doing business or practicing his or her profession. Okay, so this the purpose why the law provides for a specific or special rules regarding the deductibility of contribution, because again, these are prone to abuse. So that's why the law sets some rules and limitations in order for the contribution not to be abused, because if this kind of expenses is overstated, so the result of the overstatement of these expenses will result to a lesser taxable income. So lesser taxable income is of course a lesser tax due that the government can collect from the taxpayer. Okay, so contributions must be made by the business and duly supported by invoice or receipts issued to in the name of the business. So the receipts that the taxpayer through by paying contribution should be under the name of the business. Please take note. And please refer to the general requisites for this for deductibility of expenses. We have already discussed on the previous video and we have already reviewed earlier. Okay, contributions and donations of a taxpayer may be deductible in full or deductible, partially deductible, but subject to limitations. Okay, so there are two types of contributions. One is can be deducted in full, and the other one is it can be deducted, but it should be subject to certain limitations that we are going to discuss that on the next slide. Okay, so first, let's discuss contribution deductible in full. So it means that the actual contributions paid to that particular charitable organization can be claimed as deduction to the gross income of the taxpayer in full, the actual amount. So what are those contributions that is considered deductible in full? First, donations to the government of the Philippines or to its agencies or political subdivisions, including fully owned government corporations, exclusively to finance, to provide for, and to be used in undertaking priority activities in the following areas. Is first is for science, second for education, third for culture, so health and economic development, human settlement, and youth and sport development. So donations or the receiving government agencies and its political subdivisions, including GOCCs, uh, should be undertakes the enumerated priorities. Okay, so if the donations is not on the mentioned priority activities, so therefore the charitable contributions donated to the receiving charitable organization can be deductible under certain limitations. So these are the reasons or the activities lang which the taxpayer can claim full credit to its gross income if these donations are donated to the Republic of the Philippines and its instrumentalities, including the GOCCs. Okay? The next, we have donation to certain accredited non-government organizations. So the second recipient, which the contribution can be deducted in full, is for non-government organizations or what we call NGOs. Take note that the organization of this NGO should be non-profit domestic corporation. Take note, non-profit. In short, these domestic corporations is not issuing shares of stocks. That please take note. So organized and operated exclusively for. So in short, guys, the function of the NGO or a non-profit domestic corporation is uh, has a single reason or priority or the purpose of its organization is for the following: for science, for education, for culture, health, and character building in youth and sports development, so charitable, social welfare, and research, or any combination of the above purpose satisfying certain requirements, no part of the net income of which inures to the benefit of a private stock or individual. Take note, guys, that no part of the net income. It means that on the view of the receiving NGO or non-profit domestic corporation, no income received or no gross contributions received by these mentioned NGOs should be given to any private stockholder or individual. Because in the first place, guys, non-profit domestic corporation is not issuing a shares of stocks. So letter number 8, benefit to any private stockholder or individual is most likely impossible because this corporation is created not for profit. So, in my experience in the Securities and Exchange Commission, when you organize a corporation for the purpose of for a non-profit domestic corporation, so it is strictly adhered by the Securities and Exchange Commission to check how the net income is distributed, how the collection is nang appropriated or allotted to each of to the activities of the NGO. So medyo stricter ang pagbantay or ang pag-oversee sang Securities and Exchange Commission with regards to non-profit domestic corporation. Okay? So, letter B. So, if ever you are the taxpayer and you have contributed to these activities, and the receiving entity is a non-government organization which is accredited, and its organization is non-profit domestic corporation, so your contribution can be credited in full, or the actual contribution can be deducted from your gross income in order to arrive at your taxable income. Okay. Next, contributions in full. We have letter C. So, donations to foreign institutions or international organizations in compliance with agreements, treaties, or commitments entered into by the government of the Philippines and the foreign institution or international organization, or in pursuance of special laws. So, what you are going to look at letter C is that the Philippines is a signatory to the agreement or to the treaties. Okay? To the foreign institution or international organizations. When you say international organizations, these are non-government organization. Okay? So please take note. Letter C. Next, gali, I'm sorry. Contributions subject to limitation. So in this case, the contributions uh, do, provided to this particular recipients should be subjected to limitations. So in short, not all or not the full amount of the contributions can be claimed as deduction to the gross income of the taxpayer. So, sino-ni sila? First is to the government of the Philippines or any of its agencies or any political subdivision thereof, exclusively for public purpose. Okay, so those mentioned on letter A earlier, but there is no priority activities. Okay? So, ang priority activities, wala to sa na-mention kagina. So, in that case, your donation or contribution can be claimed, but it is subject to limitations. Letter B, to a non-government accredited corporations or associations which are domestic, organized, and operated exclusively for scientific, uh, cultural, youth, sports, development, charitable, social welfare, religious, or rehabilitation of veteran. So guys, the difference between letter B under subject to limitations and letter B, which is deductible in full, is that the word non-profit corporation. Take note guys, non-government accredited corporations or associations lang. In short, these are domestic corporation which is organized as a stock corporation or for-profit corporation siya guys. Take note, for-profit corporation siya. Unlike sa letter B kagina, please take note. Let's review. Letter B is a non-profit domestic corporation. So in this case, your donations or contributions can be deducted in full. On the other hand, if the receiving non-government accredited corporations or associations, in short, we can assume that this is a domestic or a profit-oriented kind of corporation, but it is organized for the following, almost synonymous with letter B on the previous slide. Okay, so that is scientific, educational, cultural, youth and sports development, charitable, social welfare, religious, or rehabilitation of veteran. So the missing link with regards to letter B is that number 8. No part of the net income inures to the benefit of any private stockholder or individual. Okay, so in that case, your contribution is allowed to be deducted but subject to limitation. Okay, number 3, no part of the net income of which inures to the benefit of any private stockholder or individual. But take note guys, the only difference lang, let me correct myself earlier, the only difference lang is the organization of the non-government accredited corporation. In this case, we can assume that this is a profit-oriented. So therefore, your contribution is only subjected to limitation. So next, requirement for on the accredited non-government organization. So first, not later than the 15th day after the close of the year in which the contribution is received, makes utilization, so within 15 days lang dapat, directly for the active conduct of the activities consisting of the purpose or function of which it is organized and operated. So atong din pang-mention earlier, it should be utilized or the contribution for the purpose of that mentioned activities earlier should be within 15 days. That's the first requirement. Second, administrative expenses do not exceed the level prescribed by the Secretary of Finance and not exceeding 30% of the total expenses. Take note guys for the word 30%, not exceeding 30%. Therefore, administrative expenses should be limited only to 30% of the total expense. So therefore, 70% of the expenses, total expenses of accredited NGOs should go directly to the activity on which the NGO is organized and created or operated. Okay? So if the administrative expenses exceeds 30%, so that NGO is no longer accredited by the government. And therefore, if you are not accredited, your contributions may not be considered as a deduction to the gross income of the donor or of the taxpayer. Take note, what are administrative expenses? So these are office salaries and wages of office personnel, office supplies, buildings, depreciation on office buildings, stationaries, and other related expenses to the on the administration of the activity of the NGO. So take note guys, it is only up to 30%. Okay? So it should not exceed 30%. So dapat 30% less than. Okay? So in our case, in my experience as an auditor, I have handled two non-government organization. So one of our part of our audit program is to check whether the administrative expenses exceed the amount allowed by the law, which is 30%. So that is one of our audit program during my time as an auditor. Okay? So next, the assets in the event of dissolution will be distributed to another non-profit domestic corporation. So guys, in case that the receiving or the recipient NGO uh, will be dissolved, when we say when we be this dissolution, it means that the assets of the company is distributed to those beneficiary. So take note that the beneficiary should be a non-profit domestic corporation manjapon, which is organized for similar purpose. So the point is, no part of the asset or income of the NGO should go or inure or benefit certain individual. Okay? So dapat strictly all of the assets and collections or income or revenue by the accredited NGO should go directly to its cost or to its priority activities, or in case of dissolution, it should be donated or it should be transferred to an accredited NGO man organize the same or similar purpose with the NGO on which the contributions is ng directed to. Okay? So the state or either to the state or to be distributed by a court to another organization to be used in such manner that it will accomplish the general purpose of the dissolved corporations. In case of dissolution lang guys, the main purpose lang it should be transferred to the same or NGO or to the state or that to the government, or the court will accomplish or will transfer it with the same organization. If wala sang may makita ang NGO man with the same cost or with the same purpose, ang court will find an organization, not necessarily a non-government organization, but the court feels that it is in continuance of the purpose or in continuance with the priority activity of that particular non-government organization, accredited non-government organization, or accredited NGO. Okay, so these are the three requirements in order for the accreditation of non-government organizations. So if you receive um, accreditation as a non-government organization, all of your contributions that you are going to receive, your donor will be allowed for a full credit in their gross income. Okay? Full credit in their gross income. Okay, limitations on deductibility for contributions. So, deduction is the actual contribution, but in the case of individual, okay, this is the limitations we are talking about. Kagina. So, take note, we have two types of contribution. One is contribution deductible in full, and the other one is contribution subject to limitation. And these are the limitation on that second type of contribution. Okay, one is for individual, the deduction must not exceed 10% of the taxable income of the business or practice of profession before deduction of contribution. So guys, you have to consider or you have to compute your gross income less your itemized deduction, excluding, wala labot, okay? Excluding contribution. Then the result will be taxable income before contribution. Multiply it by 10%. Okay? So the 10% should be compared to your actual contribution, and whichever is lower should be the allowed contributions to be deducted from the taxpayer's gross income. So I have an illustration later on. So for corporation, deduction must not exceed 5. So take note, for individual, that's 10%. For corporation, that's 5%. So let's analyze or let's apply it in this problem. Illustration, limitation, and deductibility. So gross income is 800,000 and business expenses not including contribution. Please take note, the business expenses excluding 600 contribution is 600,000. So contributions deductible in full in the amount of 5,000 and contribution subject to limitations of 25,000. Take note guys, 5,000 maybe it is donated to the Republic of the Philippines or its instrumentalities, and the main purpose for this contribution for that contribution is for the advancement of science and technology, so that makes 5,000 deductible in full. So no question, you are allowed to deduct from your gross income the amount of 5,000, but the question is the contribution subject to limitations of 25,000. So maybe this 25,000 is donated to an organization, NGO, which is not on a on not on a national government organization which is considered as profit domestic corporation. So that's why the 25,000 is subject to limitation. Okay, so for individual, in the case if our taxpayer is an individual, the limitation should be your gross income, that's given, 800,000. Then less itemized deduction. Specifically for this computation lang, ging exclude ang contribution. So that's 600 as given, not including contribution. Please take note. So the taxable income for the purpose of limitation lang, I'm going to emphasize on that. Taxable income for the purpose of limitation is only 200,000. So the limitation is 200,000 times 10%, which is already discussed earlier. We have the limitation of 20,000. Okay? So the actual contribution is 25. Thus, only 20,000 plus 5,000 nga contribution, which is not subject to limitation. Ano ginang ref. This is what is meant by the 5,000. Okay, which are not subject to limitation are allowed to be deducted from gross income. So guys, the actual contribution is 5,000 plus 25,000, that's 30. That is the actual outflow on the part of the taxpayer. But for the purpose of the computation of income tax, the only allowed contribution is only 25. That is the limitation of 20. Because if you're going to compare the limitation of 20 and the actual is 25, we cannot claim an amount more than the limitation. That's why, as I've said earlier, you have to compare between the actual and the limitation. Whichever is lower is the allowed contribution. So that's 20,000 plus 5,000, which is not subject to limitation. So the only allowed deduction from contribution, deductible contribution is only 25,000 instead of 30,000. Okay? That's for individual. How about for corporation? I believe it is the same computation. Gross income 800, then deduction excluding contribution is 600. Taxable income for the purpose of limitation is 200,000, same earlier, same with individual, but the difference will be the rate of limitation. So for corporation, that's 5%. So instead of 10,000, instead of 20,000 for individual, it is 10,000 for corporation. Okay, so the actual contribution is 25. So thus, this is what is meant by the actual contribution, 25. Thus, only 10,000 because 25 compared to 10, 10 is lower. So therefore, what is allowed is the lower amount between the actual and the limitation. So 10,000 plus the 5,000, which is not subject to limitation. So the allowed deduction for contribution is only 10 and 5. So that's 15,000 instead of 5 and instead of 5 and 25. Okay? So 15 instead of 30. So that's how to treat contribution for the purpose of income tax computation. Okay, so let's proceed. So let's discuss taxes. Okay? So what are taxes? How to treat taxes for the purpose of the computation of income tax. So in general, taxes paid or accrued within the taxable year in connection with the taxpayer's trade, take note guys, in connection with the taxpayer's trade, business, or practice of profession. So personal taxes should not be part of your computation. Take note, should not be part. It is always in connection with the taxpayer's trade or business or practice of profession. Are deductible from gross income with exemption of those with respect to the law which the law does not permit. Okay? So non-deductible, let's discuss what are non-deductible taxes according to the National Internal Revenue Code. First is, of course, the Philippine income tax. So we cannot common sense will tell us that we are computing for the Philippine income tax. So there is no possibility that we can deduct what we are computing. So Philippine income tax. Okay? Then second, we have your estate tax. Okay? Why? Because the reason is that is not in relation to the trade, business, or practice of profession of our taxpayer. Because estate tax is the tax for the transfer of property from a dead owner to its beneficiary or heirs or to his or her recipient. So in short, that is not related to the trade or business. Then, of course, donor's tax as well. Okay, so these are the transfer of property from donor to donee. So this number 2 and number 3 will be discussed next semester. Please take note for these enumerations made by the National Internal Revenue Code. Fourth is your special assessment. So special assessment, guys, are special taxes paid by individual or corporations in relation to the increase of value of the property because of government project. Okay? Because of government projects, the property of this taxpayer increases. So therefore, the Bureau of Internal Revenue may impose special assessment, okay, or additional tax. And that kind of tax cannot be deducted from the taxpayer's gross income for the purpose of income tax computation. Fifth, income tax imposed by foreign country, of course. You cannot deduct taxes collected or imposed by a foreign country. Then we have your value added tax. So guys, you will learn next semester or in your business taxes that VAT is impossible to be deducted from the taxpayer's business. Why? Because value added tax is an indirect tax. So if you receive your sales which is subject to VAT will be compensated or offsetted between the taxes or VAT from your purchases. So we have what we call output tax and input tax in our tax 2 next semester. So the taxpayer will just remit to the Bureau of Internal Revenue the difference between the VAT which is sold to the consumer or to the buyer, then it will be offsetted against the tax received from your supplier, trader, or manufacturer, as the case may be. So it is indirect tax. So the taxpayer or the business should not deduct VAT from his gross income. Okay? Next, we have your take note. If a taxpayer is qualified to take tax credit for foreign income tax, such taxpayer may not tax a tax credit, but instead he may claim a deduction from foreign gross income for foreign income tax. Okay? So there are two options for letter number 5. One is you can claim it as a tax credit, or number 2, you can deduct it directly from your gross income if you are qualified to take tax credit. Okay. Illustration for taxes. So a company paid the following taxes and addition to them in the taxable year. So given data are, we have your community tax or cedula in the amount of 1,200. Yes, corporation also pays cedula. Then second, deficiency income tax of 20,000. When we say deficiency income tax, please take note that income tax is just a declaration. So maybe this our company, as an example, is subject to what we call tax audit by the Bureau of Internal Revenue. So upon the conduct of tax audit, the assessors or the tax assessors of BIR identifies a deficiency of income tax on previous filing. Okay? So obviously, it will be collected from the taxpayer. Then, because of that deficient in income tax, the BIR will also charge or surcharge which is in our example, that's 5,000. That's additional penalty on the part of the taxpayer for not declaring her income tax, or in our case, the corporation's income tax correctly. Okay? Then of course, out of the 20,000, it will be subjected to interest expense. To interest, because you deprive the national government from using the amount of 20,000. So the government will impose interest on that. That's 4,000 in our example. Okay? So next, we have your compromise penalty. So compromise penalty is additional penalty imposed by the Bureau of Internal Revenue because of deficiencies or any other what we call that, ng open cases. So in order not to deprive the government from what we call due process, because it will cost both the taxpayer and the bureau additional legal fees. So instead, they will settle to a compromise penalty. So you have to pay the amount of deficiency plus surcharges plus interest and compromise penalty. That's the compromise. That's why the BIR is seeking ng charges on that, and that is called compromise penalty. Okay? So, the taxpayer will, of course, pay that to the Bureau of Internal Revenue. Then, in this case, the company receives what we call special assessment. Maybe part of the corporation's property was benefited from government projects. So, the BIR ng assessed as an additional taxes, which is 3,000 on that case. Then we have your city taxes or local taxes of 2,500. So the question of these given taxes paid by the corporation, which is deductible and which is not. So the question is either deductible or not deductible. So the computation is the allowed deduction is only the community tax of 1,200 and city taxes of 2,500. Why? Because deficiency income tax surcharges of this one, including the compromise penalty, are considered Philippine income tax. And under the National Internal Revenue Code on our previous slide, these taxes or Philippine income tax is a non-deductible taxes. Okay? Then for interest on deficiency income tax, this will form part of your interest expense and on not considered as taxes. Instead, it is interest expense. Okay? Although this is deductible, but it is not deductible under the title of taxes. Instead, it is under the title of interest expense. And we will discuss that later. So, special assessment. So, in our previous slide, it is enumerated in the National Internal Revenue Code that this kind of collections or taxes is a non-deductible taxes. So only 3,700 will be form part of the taxpayer's deduction as in the case of taxes. Okay, take note. There is a deduction for the interest on deficiency income tax as interest expense and not a tax. Deficiency income tax is not deductible because it is an income tax. Surcharges and penalty are not deductible as well. A tax to be deductible, it must be direct tax. So it must be a direct tax. So value-added tax is not part or is not considered as a direct tax. That's why in our previous slide, it is not part of a deductible taxes. Percentage tax is deductible because it is part of cost of the product or services. Please take note. We have no percentage tax in our illustration, but please take note, percentage tax is deductible because it is part of the cost of product or services, but it is not deductible as a standalone taxes, but it is part of the product or it is part of the cost of goods sold or part of the cost of services. Please take note. So, dapat ang percentage tax wala man sa computation natin. It should be included in your cost of goods sold or cost of sale or cost of services. So real property taxes on property used in the operation is also deductible. Please take note, we have another deductible taxes which is your real property. As long as the property is under the name of a co or a corporation, and it is used in the conduct of business and trade of a corporation. Okay, so that's for taxes. Next, another type of itemized deduction is interest. So interest is, the general rule is that any amount, if the interest paid or accrued during the taxable year on the indebtedness in connection with the trade or business or with the exercise of profession is deductible from gross income. Okay? Any amount ko no, according to the definition provided by the law. So what are indebtedness? Indebtedness is a sum of money owed by one person who is unconditionally bound to pay, and interest is the amount paid for the use of the money. So for receivable, the indebtedness has a cost which is called interest. Okay, so interest in advance. So when we say interest in advance, you already paid the interest of your receivable of your or of your debt. So that is termed in accounting as prepaid interest. So what is the treatment for prepaid interest? So deduction will be in the year that the indebtedness is paid under cash basis. If the indebtedness is payable periodically, the amount of the interest which corresponds to the amount of the principal paid during the year will be allowed as deduction in the case of in such taxable years. So that's accrual basis. Both of the bases are allowed or accepted by the BIR. Okay? As long as you will indicate what is your basis, either cash or accrual. So for cash, actually paid. Okay? For cash rather, for accrual basis, so the interest related to that particular taxable year only is the amount of the interest that can be deducted from the gross income of the taxpayer. Okay? So, interest on asset acquired. So, this time, guys, the company or the taxpayer acquired an asset or properties, equipment, machineries, vehicles, computers, any other equipment that will be considered as an asset. So, the purchase is on account or on installment. So, therefore, there is interest on the purchase of the asset. So how to treat the interest from the purchase of asset? So at the option of the taxpayer, interest incurred to acquire property that will be used in the trade or business or practice of operation may be allowed as an outright deduction from gross income. So using the same principle earlier, so you can deduct it from your gross income. Okay? For cash, that should be the amount paid. For accrual, so the amount of interest which is in related or incurred during the taxable year is the amount to be deducted. That's letter A for the first option. Or it can be considered as a capital expenditure to form part of the cost of the asset. So in short, guys, if you paid machinery worth 10,000 on account for 2 years, so the interest, for example, is 2,000. So the amount of 2,000 interest, it should be form part of the cost of the asset. So instead of recording 10,000, which is the actual price of the equipment, you should include the interest. So instead of 10, you will record it as 12,000. Okay? So for the benefit of computation of income tax, the interest, particularly on that capital asset, should be claimed as deduction to your gross income, not as an interest expense, but instead it should be deducted from the gross income of the taxpayer in the form of depreciation. Okay, depreciation and not interest. So the reduction of interest expense. So the interest expense, the interest deductible from gross income will be reduced by 20% of the interest income subject to final tax. That's under create law. So for your information, guys, before the implementation of create law, the reduction to the deduction for interest expense is 33% for individual and 30% for corporation. But under create law, it is reduced to 20%. So this is favorable to the taxpayer. Okay? So the provisions of create law to reduce from 33% to 20% is a move, favorable to the taxpayer. Sa una, that is 33%. Subong 20 na. So, how to apply? For example, the given information are interest income subject to final tax is 100,000. The actual interest expense is 40,000. So, interest income, guys, this is the amount ang taxpayer naton is the creditor. Okay? So, in short, kita ang nag-lend sang money. That's why ang interest in return is 100. And this 100,000 is not part of our gross income because in our previous topics, interest income is considered passive income. And passive income is subject to final tax. Therefore, this 100,000 is not part of our computation. Please remember. Okay? So, what our concern is the 40,000, which is the actual interest expense. In this case, we are the debtor. We are the debtor. We are the one who borrows money and pays it based on the agreement. And our payment to the principal includes interest expense of 40,000. So our concern is how to treat 40,000 for the purpose of the computation of taxable income. Okay, so the computation should be your actual interest expense of 40, ara siya, 40. Then take note, the 20% is a reduction to the deduction for interest expense. So in short, we have to reduce the amount allowed of 40. So that is 20% of your interest income subject to final tax. Please take note, this 100,000 is gross. Gross ni siya, guys. 100,000 is gross. So take note, that is 100,000 times 20% limitation rate. The amount is 20. So we have to reduce this amount as according to our discussion earlier, you have to reduce this amount to your actual interest expense. So the amount of 20,000 is the amount allowed as expenses or interest expense to be deducted from gross income. So guys, the reduction of 20% is only applicable if the taxpayer has interest income and interest expense. If you don't have interest income, so this amount is 0. 0 times 20% is equals to 0. So therefore, you can claim the entire actual interest expense as deduction from the taxpayer's gross income. Okay? So that's how to apply or how to treat interest expense for the purpose of the computation of uh, deduction from gross income. So next, we have losses. So we have losses. Okay, losses. So losses actually sustained during the taxable year and not compensated by insurance. Okay? Take note for the word not compensated by insurance. It means that if your property subject to losses is insured, you cannot deduct your losses from your gross income because in the first place, it was indemnified by an insurance company. So that's unfavorable to the part of the government if the insured property, the losses of it will be deducted to the taxpayer's gross income. So any other form of indemnity are deductible. Not compensated, please take note. Wala insurance. So if incurred in trade or business, that's the reason that's the requisite requirement that you can claim your losses as a deduction to your gross income of the property connected with the trade or business if the loss arises from fire, storm, shipwreck, and other casualty, or from robbery, thief, or embezzlement. So guys, take note, the reason for the loss should be involuntary or because of fortuitous events. So declaration of loss. So the taxpayer must submit a declaration of loss in the casualty, robbery, thief, or embezzlement during the taxable year, which must be by provision of law within a period of not less than 30 days or more than 90 days, so between 1 month to 3 months from the date of the recovery or discovery of the casualty, robbery, thief, or embezzlement, as may be fixed by the BIR regulation or revenue regulation. The revenue regulation has fixed the period to 40 days. Guys, as of now, the law provides for a period of 1 month to 30 days. But it is subject to revenue regulation. So right now, the revenue regulation has fixed the period to 40 days from the date of discovery. So dapat within 40 days from the date of discovery, the taxpayer the taxpayer should report or should submit a declaration of loss. Okay? So the requisites and amount of loss. So a loss to be deducted from gross income must be actually sustained during the taxable year. Actual, guys, actually sustained. Next, not compensated by an insurance or other forms of indemnity. There must be a charge of the loss at the asset in the books of accounts. So there should be an accumulated depreciation of 20 and loss of 10,000, sorry, not accumulated, and a credit to machinery. Okay? So guys, since the machinery is already depreciated by 60%, I guess. Yes, by 60%, which is the 20,000 accumulated depreciation. So the amount of loss is only the book value of the machinery. So that is 30,000 less 20,000 depreciation during the time of the unfortunate event. So the difference is 10. So the amount of loss is only 10 and not the entire cost of the machinery, because 20,000 which was already benefited the company and it was claimed in as deduction to the taxpayer's gross income through depreciation. Okay, please take note. When a loss actually sustained, saan o ka na makonsider that the loss is actually happened or sustained? A loss is actually sustained if it is evidenced by a completed transaction. So there must be an identifiable event that causes the loss. So when the loss results from a sale, the consummation of the sale is identifiable event which fixes the loss, and the deduction will be claimed in the year that the sale was consummated. So the sale is consummated only, when we say consummated, guys, completed, only when there is a delivery of the thing sold. Okay? So a loss from theft is deductible in the year of the theft. A loss from embezzlement is deductible in the year in which the embezzlement took place. If the owner of the property cannot recover the property anymore, the embezzlement of funds creates a debtor-creditor relationship, and the loss become deductible in the year when the recovery becomes impossible. Okay? So that is, next is partial loss. Partial loss. So when we say partial loss, in a case of partial loss of property used in trade or business or in the practice of profession, the measure of loss is cost to restore the property. So if the property is partially damaged, how much money that the company will pay in order to restore the property to its original operating condition. Okay? To its normal operating condition, or book value, whichever is lower. So that is the figure that we are going to compare on the recognition of partial loss. Less cost, less accumulated depreciation. So the book value will be your cost or the original purchase price and any other capitalizable expenses in relation to the purchase of the property less the accumulated depreciation. So that's the computation on book value. But for the purpose of identifying which value we will consider, you have to compare the restoration cost. This is the restoration cost or the book value of the property. So the difference should be, or whichever amount is lower, should be less or deducted by the insurance recovery or any form of the indemnity. So if the property is insured, so the amount that can be deducted from the gross income should be net of indemnity. Okay? So the difference is the deductible loss. So if ever that the property is not insured, so of course your less insurance recovery is zero. Therefore, the entire book value or restoration cost, whichever is lower, is deducted in full in the taxpayer's gross income. Okay? So last is illustration costs. We will continue our discussion on the next na lang. I think it needs part 3. Okay, so illustration, partial loss. So office equipment with a book value of 100,000 was partially destroyed by fire. So the cost to restore the property to its normal operating condition was 120,000. So medyo dako pa ang restoration cost niya. So in short guys, the property is beyond repair if are going to assess based on the figure given. Beyond repair na siya or it is economical if we're going to buy a new equipment instead of repairing. Okay? So there was no covering insurance. The deductible loss should be cost to restore the equipment, that's 120. Or the book value of the equipment, that's 100. Take note, the initial loss should be whichever is lower. So you have to compare between the restoration cost and the book value. That's 100 of course. The amount which is lower. Then, less insurance or any form of indemnity of zero since the property is not insured. If ever that the property insured, you have to consider the proceeds of the indemnity. So if the proceeds of the indemnity is lower than 100,000, so you can claim a partial loss. If the indemnity is higher than the initial loss of 100,000, let's say for example that the amount proceed received is 150, so therefore there is no loss at all. So you cannot claim a deduction, a loss as a deduction to the taxpayer's gross income because in the first place the indemnity is more than the actual value of initial loss. So please take note. That's the 3 cases or 3 possibilities that will arise if there is a destruction of equipment. So deductible loss is 100,000. Okay, so let's continue our discussion on net operating loss carryover next meeting. Okay, since we have already consumed 1 hour and the information discussed, I think, is already enough for the day. So this discussion requires part 3. So on part 3, we will continue our discussion on net operating loss carryover and the remaining types of itemized deduction. Okay.